Welcome to the Deep Dive. Today we're digging into Kestra Medical Technologies, ticker KMTS. They just had their Q1 fiscal year 2026 earnings call, dropped September 11th after the bell.
That's right. And KMTS, for anyone maybe not following super closely, is all about their main product, the Assure system. It's a WCD, a wearable cardioverter defibrillator. Think of it like a safety net you wear if you're at high risk for sudden cardiac arrest right now.
Okay, so our job today is to unpack that earnings call, look at the big numbers, the strategy updates, and this big clinical thing that seems to be coming up.
Exactly. Get past the headline numbers and figure out what's driving the stock and maybe what the market's thinking.
All right, let's start right there, the results. What was the immediate sort of takeaway, the big beat?
Yeah, the big story was just, strong execution, really strong, leading to better than expected revenue. And crucially, they immediately raised their guidance for the full year because of it.
Okay, let's get specific. Revenue numbers.
Revenue for the quarter came in at $19.37 million. The street consensus was closer to $17.87 million. So a solid beat there.
And that translates year over year.
That's 52% growth compared to the same quarter last year. 52%.
Wow. Okay, that's significant top-line growth. And when you see that kind of beat, you want to know if it's real demand, right? Did the prescription numbers back that up?
They did. Perfectly. Prescriptions for Assure hit 4,205.
Yeah.
That's up 51% year over year. So basically right in line with the revenue growth. It confirms the demand is absolutely there.
Makes sense. But revenue and prescriptions are one thing. For a company like this, scaling up, margins are just critical. How did they look?
Right. And this is maybe the most interesting part. Gross margin was 45.7%. Now compare that to last year. It was 32.9%.
Well, and 45.7 from 32.9, that's what, nearly 13 percentage points higher?
Exactly. It's a 12,280 basis point increase. So, 12.8 percentage points. And importantly, this is the seventh quarter in a row that they've expanded gross margins.
Seventh quarter. Okay. So that's not a blip? That sounds like something structural is changing, getting more efficient.
Precisely. It suggests the operational improvements they've been talking about are really, taking hold and driving leverage. And that obviously gives them confidence.
Which brings us back to the guidance. You said they raised it. What's the new target?
Yeah, they bumped the full year fiscal 26 revenue guide up to $88 million.
Yeah.
Their previous guidance was $85 million.
Okay, $88 million. So that implies about 47% growth for the full year. Still very strong.
Very strong. And they also gave some helpful color on how they expect that revenue to roll in through the year. They specifically said not to expect it to be all back-end loaded.
Ah, okay. So more of a steady climb quarter over quarter.
Yeah, a nice steady increase was the phrase, I think. Which is good, right?
Yeah.
It suggests they have pretty good visibility and confidence in the near-term pipeline.
Definitely reassuring. Now that margin, 45.7%, is great progress, but they've been talking about a much higher long-term goal, haven't they?
Oh, yeah. They're very clear about this. They reiterated they're still confident they're on a path to hit 70% plus gross margins. 70%.
70% for a device company, especially with a rental model component. That's ambitious. What's the argument for getting there?
It really comes down to the unit economics of that rental model. You've got the fixed cost of the device itself, the reusable part. As you get more patients using it, more fittings per device over its lifespan, the revenue per unit just climbs and climbs.
So volume leverage is a big piece.
A huge piece. Plus, getting better reimbursement rates, that higher revenue per fit we talked about because of better payer mix, that helps too. It all feeds into leveraging their platform.
Got it. Okay, so strong top line, improving margins, raised guidance. Let's look at the other side of the coin. Spending. Growth isn't free. What were the operating expenses?
Yeah, CAP operating expenses, or OPEX, were reported at $37.7 million. Now, they did call out that about $2.9 million of that was related to one-time costs of being a newly public company.
Okay, so maybe adjust for that mentally. But still, what did that mean for the bottom line, adjusted EBITDA?
Well, the adjusted EBITDA loss did widen a bit this quarter to negative $19.4 million.
Nearly 20 million loss in the quarter. That's a pretty significant burn rate.
It is, and it reflects that they are investing heavily, right? Building out the sales force, the infrastructure you need to support that kind of growth. It's the classic scale-up investment phase.
Right, which immediately leads to the question, cash. How much runway does that burn rate leave them with? You mentioned the balance sheet looked okay?
Yeah, that was a key point. They ended the quarter, July 31st, with a healthy $201.2 million in cash and equivalents on hand.
Okay, over 200 million. And what's the official line on whether that's enough?
Management stated pretty clearly that they project this cash balance is sufficient to get them all the way to cash flow break even and then profitability.
They didn't give a specific quarter for break even, though.
No specific date. But the confidence seems baked into hitting those continued growth targets, 45% plus, and making major continued progress on that margin expansion path towards 70%.
So if they execute on both of those fronts, the margin improvement dramatically slows the burn rate over time, making that 200 million last longer than simple math might suggest right now.
Exactly. It's all about the execution buying them the time they need.
Okay, that makes sense. Let's talk about how they're driving that margin efficiency. You mentioned revenue cycle management, RCM. That seems critical here.
Absolutely critical. Because getting a prescription is step one, but turning that prescription into actual collected dollars, especially with insurance, that's the whole game in RCM.
Yeah.
And they showed real progress.
How so? What metric really stood out?
The biggest one was the improvement in payer mix. Remember, they IPO'd just about 6 months ago, right? Back then, about 70% of their device fittings were for patients who had in-network insurance coverage.
Okay, 70% back then, and now?
Now it's approaching 80%. That 10-point jump is huge.
Why is in-network so much better? Faster payment? Less hassle?
Both. In-network claims generally get processed quicker, there are fewer denials or challenges, and you ultimately collect a higher percentage of the billed amount. It smooths out the whole collection process.
Okay, so better payer mix. Did that translate directly into a better overall collection rate?
It did. They tracked this thing called the conversion rate, basically. What percentage of prescriptions eventually turn into cash collected. That rate jumped up to approximately 47% this quarter.
Compared to
About 40% in the same quarter last year. So a 7 percentage point lift just from getting better at the billing and collection side, that's pure operational improvement.
And it's not just about signing better contracts with insurers, right? They've actually changed how their internal RCM team works.
Yeah, that was interesting. They described it as evolving from a small team where maybe one person handled everything for a claim to now having specialized groups.
Like specialized how?
So you've got one team that only does prior authorizations. Another team focuses only on the medical review process if a claim gets questioned. And a third team manages the actual claim submission and follow-up.
Ah, specialization drives efficiency, like an assembly line for claims.
Kind of, yeah. And they said that specialization is really increasing both the speed of collections and the overall success rate.
Makes total sense. But you still have this vast landscape of payers in the US, thousands of them, right? Do they need contracts with everyone to make the model work?
No, and management was smart to address that. They basically said, look, there are over 3,000 payers. We don't need deals with all of them right now to hit profitability. Their model assumes a gradual increase in that conversion rate, maybe from the high 40s now up into the high 50s over the next few years.
So focus on the big ones, the ones that move the needle, rather than trying to boil the ocean.
Exactly. Deepen the key relationships first.
Okay, so that improved RCM feeds the margin story. Let's link this to the commercial strategy. How are they growing the sales footprint without just, burning cash inefficiently?
It seems pretty disciplined. They're adding territory managers, but strategically. They're prioritizing areas, geographies where you have two things already in place. One, good underlying demand for WCDs, and two, strong existing payer coverage.
So they're putting reps where they have the best chance of converting prescriptions and getting paid quickly because the insurance is already lined up.
Precisely. It maximizes the efficiency of each new hire right out of the gate. They're not sending reps into markets where the reimbursement is still a big question mark.
Smart. And they're also changing the roles within the sales team to get more leverage.
Yeah, this was a neat update. They're expanding the role of the clinical specialist. These specialists will now take over more of the day-to-day account management for existing, established, high-volume accounts.
Okay, so the specialists handle the existing business.
Right, which frees up the primary territory managers, the main sales reps, to focus almost exclusively on hunting for new prescribers and opening up brand new accounts.
That's clever. Use different skill sets, different cost structures potentially to cover both farming existing fields and finding new ones?
Exactly. It's about getting leverage out of your sales investment. And they mentioned, by the way, that their territory coverage across the U.S. is currently just over 50%.
Only 50%. So still a lot of geographic white space to go after, even with this targeted approach.
A ton of white space, which ties into the bigger market picture. They keep emphasizing how underpenetrated the whole WCD market is.
Right, what was that number they use?
Only about 14%. 14% of the U.S. patients who are estimated to be eligible for a WCD are actually getting one.
Wow. So like 6 out of every 7 patients who could potentially benefit aren't using one.
Yeah. So the growth potential isn't just about taking share from competitors. It's about significantly expanding the entire category. Huge headroom.
Okay, that's the long-term potential. But there's a very significant near-term event they discussed, this clinical catalyst. What's the story there?
This is potentially huge. They announced they've finished enrollment in their big FDA-mandated post-approval study for the Assure system.
Finishing enrollment is good, but why is this particular study such a big deal?
Scale. It's the sheer scale of it. They expect this to be the single largest study ever published for any WCD. We're talking like 24,000 to 25,000 patients included in the data.
25,000 patients, that's massive for a device study.
It's enormous. And that scale is almost certainly why the data got accepted for a late breaker presentation slot at the American Heart Association, meaning the big AHA conference coming up in November.
AHA, late breaker. Okay, that's prime time in the cardiology world. November isn't far off. What specific things will they be presenting? What should people watch for?
Well, the key clinical endpoint is obviously shock success rate. Does the device work when needed? But almost as important will be the safety data. Things like inappropriate shocks, false alarms. Those are big factors for doctors and patients.
And compliance too, right? How often patients actually wear it?
Definitely. And they already hinted that the compliance data looks good, mentioning median wear time is over 23 hours a day, which is fantastic for something you have to wear constantly.
So the goal here with this massive data set at AHA is what? Just show good results?
It's more than that. It feels like a strategic move to definitively answer any questions about clinical evidence compared to competitors. One competitor in particular has historically pointed to having more published data.
So Kestra is basically planning to drop this 25,000 patient nuclear bomb of data to say, game over on the data debate.
That seems to be the play. Use overwhelming scale to validate Assure's performance and safety, and effectively neutralize the competitor's talking point about having superior data. It's clinical evidence as a commercial weapon.
Okay, that sets things up perfectly for our next segment, the not financial advice segment, where we take all this and try to spin up a, let's say, interesting trade idea.
Absolutely. And the usual giant disclaimer applies. This is purely for discussion and entertainment. Please do not run out and make this trade. Consult a professional. Assume we're probably wrong.
Loud and clear. So, the setup. KMTS is executing well, beating numbers, raising guidance, margins improving, but the stock hasn't exactly rocketed compared to some peers over the past year.
Right. And while the guidance raise is nice, we think the market might still be sleeping on just how impactful this AHA data release could be in November. That 25,000 patient data set feels like a potential re-rating event.
So if you believe that AHA data is the big catalyst, how do you play it, especially given the stock might be range-bound until then?
We were thinking about a way to play for that upside potential from AHA, but maybe offset the cost a bit. So the idea is a leveraged volatility play.
Okay, leveraged volatility. How does it work?
The specific, outrageous but plausible trade is this. You fund the purchase of some longer-dated call options, say, looking out to March 2026, maybe targeting the $30 strike price.
Okay, long calls betting on a move higher long term.
But you fund those long calls by simultaneously selling some shorter dated out-of-the-money put options. For example, selling puts that expire right around the AHA meeting in November 2025.
Okay, so sell near-term puts to collect premium, use that premium to help pay for the longer-term calls. What's the rationale?
Two parts. First, you're betting that maybe volatility stays somewhat contained before AHA, so the premium you collect from selling those November puts is decent. You're harvesting short-term option decay.
And using it to buy time for the real catalyst.
Exactly. Second, you're making a strong directional bet that the AHA data, the scale, the results, is going to be positive enough to fundamentally change the narrative around KMTS, justifying that longer-term $30 call target and breaking the stock out. It's using short-term option structure to finance a bet on a major specific catalyst.
Got it. Sell near-term downside protection to fund a longer-term upside bet, timed around a specific clinical data release. Definitely fits the outrageous but plausible category.
That's the idea.
All right, let's pull it all together. Quick recap of our deep dive on KMTS Q1. Strong quarter, beat estimates, raised guidance, good progress on making the business more efficient, especially on the RCM side, pushing those gross margins higher towards that ambitious 70% goal.
Yeah, the core story seems intact.
Yeah.
Keep scaling the sales force smartly in those high priority areas, keep improving the operations, and then all eyes on November for that potentially practice-changing AHA data presentation.
They're definitely executing, taking share, optimizing the engine, and lining up what they hope is a clinical knockout punch.
Seems like it.
Okay, so let's leave our listeners with a final provocative thought to mull over. We know the WCD market is only, 14% penetrated. KMTS is going after the easy part of the remaining 86% first, targeting areas with good demand and good payer coverage already in place. The question is, how quickly can they really capture that prime, high-value slice of the market before investors start demanding more? Before the focus shifts from just growth and margin expansion to actual operating leverage and a very clear, concrete timeline to profitability that doesn't rely entirely on that current cash pile.
That's the tension, isn't it?
Yeah.
The growth is great quality right now, but eventually the market demands the payoff in terms of sustainable profit. How long does that execution honeymoon last?
Something to think about. That's all for this deep dive. We'll catch you next time.